So let's talk about an investment that on the surface seemed absolutely perfect. I mean, you get guaranteed returns, it's backed by the government, and you're helping the planet. It sounds like a total win-win. But what if that same investment was actually structurally designed to become worthless, leaving you trapped with a mountain of debt? Well, that's the hidden story of solar power investing and how a prized asset can turn into junk right before your very eyes.
And this is where it all starts. This is the hook, the single most seductive line in the entire sales pitch. On simulation, it's highly profitable. It's a promise of perfect, predictable returns on paper. But, as we're about to find out, the simulation and the cold, hard reality are two very, very different things.
So where did this guarantee even come from? Well, it all goes back to a government program called the FIT, or Feed-in Tariff System. The idea behind it was actually pretty simple. To kickstart renewable energy, the government basically forced power companies to buy solar electricity at a super high fixed price for 20 whole years. For an investor, this sounded less like a risky business and more like a safe government bond.
And for those who got in early, that fixed price was a staggering 40 Japanese yen per kilowatt hour. Now, this wasn't just a decent rate, it was an absolute golden ticket. It's what made those profit simulations look so incredibly convincing. The income side of the business plan, it seemed totally locked in, safe and secure for 2 decades.
Okay, so if the income is guaranteed by a state-run program, it seems like a can't-lose situation, right? But this brings us to the most crucial question of all. And a deal that sounds this good, who's really making the money? And are the investor and the person selling them the system, are they even playing the same game?
The plan they show you, the investor, is beautifully simple. It's a 3-step path to easy passive income. Step 1, you get a loan. Step 2, you buy the facility. Step 3, you just sit back and collect the checks from the electricity sales. It's sold as this almost automatic, hands-off business. Super easy to understand. And this right here is the fundamental problem. It's a total disconnect. You, the investor, think you're getting into the 20-year business of generating power. But the seller, they're not in that business at all. Their goal is completely different. They want to make a big, one-time profit by selling you the system, and, more importantly, by selling you the story of its profitability. The second you sign that contract, their game is over. But yours is just beginning. You see, the seller's money doesn't come from selling electricity over 20 years. No way. It comes from the markup on the equipment, the fees for arranging the loan, and locking you into maintenance contracts. Their entire profit, I mean all of it, is secured the moment you sign the papers. Your long-term success or failure is completely irrelevant to them. So we've established that the seller's profit is immediate and totally disconnected from how well the asset actually performs. And to make that profitable sale, they have to paint this really rosy picture that highlights those guaranteed returns. But what about the unspoken risks? What are they strategically leaving out of the conversation? This is probably the most important question you can ask in any complex deal. It's not about checking the facts they give you, it's about digging for the information they don't give you. That's where the real danger is always hiding.
And it really boils down to 3 huge things that the sales pitch just conveniently glosses over. First, those power generation forecasts are based on perfect ideal conditions, but real-world output can be all over the place. Second, the real costs of maintaining and replacing equipment are often seriously downplayed. And third, and this one is the killer, the fact that there's basically no secondary market to sell your facility. You have no easy way out. Let's make that second point, equipment degradation, a little more real. A power converter, which is an absolutely essential piece of the whole system, typically only lasts about 10 to 15 years. The cost to replace just one of them, it can be over 1 million yen. This single, totally predictable expense is often just minimized in the sales pitch, but it's big enough to completely wipe out years of your simulated profits. So what happens when you combine an uncertain income, big inevitable expenses, and no way to sell the thing? Well, your valuable asset starts on a long, slow, and totally predictable journey to becoming worthless junk. This timeline really maps out the life cycle of the trap. First, you buy the asset at its peak value. Then, about a decade in, you get hit with major, costly repairs. And finally, at year 20, that government-guaranteed price just vanishes. They call it the FIT cliff. And when you go over it, your revenue plummets, making the asset basically worthless. And what if you try to get out early?
Well, this chart shows you the brutal reality. The few people who might buy these things know all about the huge repair costs and that fit cliff coming up. So these facilities, they often sell for just 30 to 50% of their value on paper. And that's if you can even find a buyer at all. The value just collapses long before the 20 years are up.
So here's the bottom line, the most crucial point. This isn't just a bad investment where you might lose some money, it's a trap. You're left holding the loan, you're on the hook for ongoing maintenance and insurance, all for an asset that isn't making real money anymore and that literally nobody wants to take off your hands. Now, I know that sounds pretty grim, but what's so powerful about understanding this whole setup is learning how to spot it and avoid it in the future. The key isn't to become an expert in solar panel technology. The key is just to ask the right question. And this is the most important takeaway here. You don't need a PhD in finance or a degree in engineering to protect yourself from stuff like this. You just need to shift your perspective a little bit by asking one simple question. And here it is. Am I becoming a genuine power producer, or am I just being sold the leftovers of a system where all the real value has already been stripped out by the seller? Think about it. A real business owner understands all their costs, their risks, and how they're going to get out one day. Someone buying the leftovers is just buying a story. So the next time you see an investment that seems almost too good to be true, ask yourself that question. Are you the business, or are you just the last customer in line?